All right, with Chapter 4, we're going to be looking at the adjusting entries and also their impact on financial statements. And we're also going to be looking at the closing entries to show you how that process works. All right, so the first up is to talk about why we actually do these things called adjustments. So like I said, most accounting systems are usually designed that they usually record mostly recurring transactions, daily recurring transactions. So this is mostly the repetitive nature that where the computer steps in. So typically where the adjustment usually falls in is the timing of usually it's cash, because lots of times cash is not always received or paid in the period in which the company earns the related revenue or expenses. So I'm going to be mentioning this in this lecture a lot as I go through some of the problems, but the key will be eventually is we'll be talking about, again, the matching principle. And the matching principle, again, is where, again, revenues are recorded when they're earned, again, not necessarily when cash is received. And then the expenses are recorded when they're incurred, not necessarily when paid. And we always like to say that, let the expenses follow the revenues, and therefore you want to match them. And the adjustments are essentially the tool that's going to allow us to match those, to let us do that matching principle. So typically, again, whenever we do adjustments, we're going to be affecting both the income statement and the balance sheet financial statements. And again, every time we do an adjustment, there will always be at least one income statement account and one balance sheet account affected. And again, here's our basic rules about revenues. Again, your revenues are recorded when they're earned. And then again, expenses are recorded in the period in which they're incurred, but again, it's to match these expenses in the period that they help to generate those revenues. All right, so let's take a look at some of these. So we've got, again, here we've got some they call deferral adjustments. And again, so an expense or revenue has been deferred if you postpone it either on the income statement until a later period. This could be where cash is either paid in advance. That's where you have what they call a prepaid, or sometimes you have cash that's received in advance, and of course that's going to be, for example, a liability, and you're going to defer that until you've actually fulfilled your obligation. Okay, so again, here's some examples of some deferrals on the balance sheet. You could buy some supplies, prepaid rent. Again, anything that's prepaid will be a prepaid, they call it prepaid expense, but these are deferrals. They didn't put one on here, but equipment, like a long-term type of asset, could also be what they call a deferral. I often call those prepaids, but it's going to fall under the same category. And then, of course, deferred revenue, that's when, of course, you receive money in advance and you haven't performed that obligation. But the point is you can see that every time you have a deferral adjustment, there's going to be a balance sheet account and a corresponding income statement account that's going to be affected. Okay. Accruals is typically when you've either incurred an expense or earned revenue and you haven't got the cash yet. Cash is not involved yet, and you have to go ahead and make sure that your financial statements get adjusted. This example where you've incurred some taxes, you just haven't paid them yet. So again, that's going to be an expense and a liability you're going to have to create. You could have also had something with interest where you've actually earned it, but that revenue still needs to be reported. So notice again, it's all about timing of cash. There's always going to be a difference in timing of cash when something's going to be recorded as a revenue or an expense. Okay, and then here's just some examples of some accrual adjustments. Let me erase my writings here, but you can see how, for example, you have an interest receivable, and the offset is interest revenue, rent receivable, rent revenue. You can see there's always going to be a corresponding balance sheet and income statement account. Liabilities, notice you've got like income taxes payable, wages payable, interest payable. Notice you have a corresponding expense account that's always going to go with that. All right, so let's get into actually making these adjustments. And again, typically this is where the accountant or the financial person comes in. Again, usually do these, it could be once a month, it could be once a year. It really depends on materiality in terms of the size of the company as well. But again, we're going to walk you through some of the basic types of adjustments you're going to encounter in this class and also, in the real world. So typically we'll go through our analysis, we'll analyze the adjustments, and then of course we'll go ahead and record and then summarize those as well. Okay, And then this is just an example of an unadjusted trial balance. So here's the first one. We've got if supplies were used during the period of 250. Remember, supplies is an asset account. And anytime you use supplies, you're going to have an expense because you need to report that expense to offset the revenue. So notice you're going to reduce your supplies. And of course, there's your expense offset, which is going to reduce equity. Your adjusting entry would be to debit supplies expense and credit supplies. And then they're showing you, they're posting these. So you see that your asset, your supplies account is going down and your expense account is increasing. And again, most of you, if you've taken applied accounting, you would have accounted supplies expense in your class there. So this one should be review one. All right. All right. So again, they're showing you here the financial statements effect, when you do that adjusting entry. And again, your balance sheet, your assets are decreasing, and on your income statement, your expenses are increasing. So therefore, income is going down, and so are assets. Another one, prepaid rent. So in this example, they're saying that they had prepaid rent on September 1st. Remember always to watch the time periods. They cost you $7,200. And they're saying this is for 3 months. So really, your monthly expense is $7,200 divided by 3, which happens to be $2,400 per month. So September 1st is when you bought it. On September 30th, you need to show that you have $2,400 of expense. The rest of it, you can see how they're allocating when that expense should be reported. So you would have that $4,800, which is what's left over, should still be on the balance sheet as an asset. But remember, you have to make an adjustment. That's the tool to make all this stuff happen to get in your financial statements. So you'll notice again, you've got rent expense, debit, credit, prepaid rent. Of course, there's your asset going down, and then there's your expense going up, which is reducing equity. And then when you post it, your balance sheet asset goes down. So notice there's what's left over of prepaid rent. And then there's your expense being debited. That's going to be increasing your expense and also reducing your income, your net income on your income statement. Depreciation is another deferral. In this case, they bought some equipment. It's a 2-year deal, and it says it's now been used for 1 month, representing an estimated expense of $400. So I know when you were in applied accounting, you might have used what they call the straight line method. In this chapter, they're just going to give you the amount of expense, but we will spend some time later on in the semester showing you the different depreciation methods. But just for now, you just need to be recognizing that depreciation expense, it's an allocation process of where you're allocating the cost of whether it's the building, the vehicle, or the equipment, to the accounting period in which they are used. So this is your matching. And also remember that you have a contra account called accumulated depreciation that again is going to show up on your balance sheet. So what will happen is every time you record a depreciation adjustment, right here you've got the cost of the equipment, the accumulated depreciation, which that'll be your adjustment. And notice that that's going to take down what they call your book value, which is your cost minus your accumulated depreciation equals book value. That book value will continue to decline over the life of the asset. So again, when you do your adjustment, so notice you've got the contra account that's reducing your asset account, and then here's your expense that's reducing equity. Here's your adjusting entry, which you debit depreciation expense and credit accumulated depreciation, and then here's the respective posting to your individual ledger accounts. So again, we will spend a whole chapter doing these long-lived type of assets, and we'll look at the different depreciation types of methods in terms of what you're using. And typically all financial statements will have some sort of note describing what type of method they're using. All right, so more deferrals. Amortization, guys, amortization is very similar to depreciation. The term amortization is used typically for your intangible types of assets. In this case, it was some sort of software use, and it was a 3-year life. And so typically you divide either by 3 or divide by 36 months, depending on if it's a monthly or yearly adjustment. But usually it's a straight line amortization. And notice how you'll have an accumulated amortization, just like you would have had for accumulated depreciation. There's your expense, That's a contra asset. And look at your adjusting entry, just like depreciation expense, except they're usually using the word amortization. And then, of course, they post to their respective ledger accounts. All right, next one was a gift card, where they accepted a gift card from customers as payment for game downloads. And you can see that this is actually earning your revenue now, so they're going to be reducing their liabilities and increasing their revenue. Remember, they've already gotten the cash, it's just now they're converting these gift cards into obligations. So you would debit the deferred revenue and credit your sales revenue. So notice you have a balance sheet account and an income statement account affected every time you do your adjusting entry. And then here's the respective postings to your ledger. All right, some accrual types of adjustments. So you've earned some revenue, but you haven't received the cash yet. So in this case, notice you're going to put that into accounts receivable, which is an asset, and service revenue, which is your equity item. Here's your adjusting entry, debiting accounts receivable and increasing your service revenue, and then they post to your respective ledger. So notice your assets are increasing and your revenue and equity are also both increasing. Here's going to be a wage accrual where you've incurred some expenses but have not paid them yet. So you're going to have a liability. So you're going to have wages expense and wages payable, salaries and wages payable, which is a liability. So here's your adjustment. So debit your wages expense for $19.50, credit your payable for $19.50, and then of course you post to your ledger. Another one, interest expense. Again, another expense you've incurred but have not paid yet. So just like wages expense, you're going to have an expense account and a payable. Here's your adjusting entry, and then of course they post to your ledger again. And then you can see they're just showing you how, of course, your tax rate, everything's going to be affected on your income statement for your income taxes that are incurred, again, and not paid. So remember, you have to, these are, again, I called your accruals. So just like interest expense, you'll have income tax expense, you'll have income taxes payable, and notice the adjusting entries are pretty much identical. They're just changing the name. So here's your expense account, and here is your liability account. And then here they're just showing you all the different accounts that have been updated and adjusted. A couple comments. Remember that when you do your adjusting entries, you never have cash in the actual adjustment. You might have cash involved in the initial transaction that creates the adjusting entry, like buying supplies or buying equipment or receiving cash, but the actual adjusting entry never involves cash. And I've been, making some comments about that. Every time you make an adjusting entry, you always have one balance sheet account and one income statement account affected. So again, why that's important, remember, if you do not record adjusting entries, then number one, you're not following GAAP, but also your financial statements, both the balance sheet and your income statement, will either be overstated or understated if you don't report those or record those adjusting entries. Just a trial balance, again, that's just like a basic trial balance. You're just making sure your debits equal your credits. That's no different. So that part is really nothing new for you guys. And then, of course, eventually we'll get to our financial statements. Remember, your financial statements should be prepared after you record your adjusting entries. And here they're just showing you that typically, you've got your income statement, or from your adjusting entry, you've got your income statement, you get your net income, and then, of course, you then prepare your statement of retained earnings. And on your statement of retained earnings, you got your beginning retained earnings. Remember, you add your net income, you then subtract out dividends to get the ending retained earnings, and then this will be the balance that then goes to your balance sheet equity account. All right, so once you've done your adjustments, then of course we'll look at the closing. And again, if you recall from your applied accounting, when you do a closing process, you have to know what the difference is between what they call temporary and permanent accounts. And typically your temporary accounts will be anything on the income statement and the dividends. All right, so notice transfer net income and dividends to retained earnings. So everything we do closing, we're going to close the revenues and the expenses and the dividends to retained earnings. Retained earnings will be updated. and then all of your income statement accounts and dividend accounts will have a zero balance to start the new period. Think of also your closing entries as you're not only zeroing out your temporary accounts, but you're also resetting your accounts for the next period. Okay. All right. So again, we'll do this in this chapter like 3 entries. I've seen it done on 1 entry where you just combine, or 2 entries, I'm sorry, but I've seen some cases where you could do everything in literally 1 entry. But to keep it simple, I mean, remember you have your revenue and expense accounts, and they're just going to be closed directly to retained earnings. So again, here's going to be your update to retained earnings, and then you're going to close out your dividends to retained earnings as well. So you can see here's some examples. Here's an example of closing out your revenues. Notice you debit your revenues, you credit your expenses, and then this $800 here, that would simply just be a plug number. Notice because it's a credit, that means there must have been income because retained earnings is increasing. Regarding dividends, doesn't look like there were any dividends, but if there were, you would be debiting retained earnings, which is to reduce retained earnings, and then credit your dividends account. And then, of course, after you've posted your closing entries, your ledger accounts like service revenue and advertising expense, notice they should all have a zero balance after you posted your closing entries. And of course, a post-closing trial balance, you'll notice that the only accounts that have any sort of balance at all should all be balance sheet accounts. Anything that's on the income statement, sales revenue, all your expenses should all be zero, as well as dividends as well. Okay. And I believe that's at least for my comments on that part. I think I've already kind of mentioned that. Again, I've talked about the adjusting entries. This is the matching principle concept. You want to make sure that all the revenues and expenses get reported in the period in which they are earned and incurred. Again, the key is to match them. And then again, the big thing here is without doing these, the financial statements are misleading and they are inaccurate. And also you're not following GAAP. So technically, if you're a corporation, a company, you are actually breaking the law if you don't record these. Okay, so let's take a look at some exercises, some adjustments. And so on this one, again, watch the dates on them. And this one is for Sky Blue Corp. They are going to give an accounting equation of the effects at the end of the month of October. So notice on part A, you've got collected rent. This is going to be a deferral, rent in advance. This is from October 1st to December 31st. And so notice what they did. In this case, you've got, well, what you would have had is you would have increased your cash. And of course, let me show this. Usually when I'm in my classes, what I like to do is just, for example, if we are, let me get my stylus on here. Let me get the right color I like. All right. So typically what I would do is I would say, okay, if you received rent for in advance, you typically would be debiting cash. In this case, it would have been for $2,400. And then you would credit, for example, your deferred revenue for $2,400. So notice I said this earlier, you've got cash here, but that cash is only to establish that you've got the money. This entry right here would be establishing the fact that now you have to do some adjustments for this deferred revenue. And in this case, it's going to be for October, November, December. So if they divide that by 3, that's where they came up with this $800 of your per month revenue. So they're showing here that as you go for each month on October 31st, you'd be increasing revenue and decreasing your liability. All right. On part B, it says you pay $1,200 for a 2-year insurance premium. And so in that case, it's going to be prepaid insurance. So what you would have done is you would have prepaid insurance for $1,200. Notice you would have been credited cash for $1,200. And then they most likely then would divide simply by 24 months. And that's where they're going to come up with that $50. So every month you'd be doing an adjustment where you'd be having insurance expense and crediting that prepaid. And then of course in the last one it says that they purchased a machine on October 1st. The cost was $48,000. They said annual depreciation is $4,800. So if you take $4,800 and divide that by 12, that'll turn out to be right around $400 per month on your depreciation expense. So notice what they do is they debit your depreciation expense and then credit your accumulated depreciation. So again, just want to show you the context of they're showing you the effect of the accounting equation, but not the effect of what happened on the initial transaction. So again, here is, in this case, they're just going to show you, like I just showed you, the calculation on how they came up with each of these deferrals. So this is just a recap of the previous one. Notice you've got that $2,400, where typically you're dividing it by 3. So debit your deferred revenue, credit rent revenue. Same thing with your insurance expense. You're dividing 1,200 divided by 24. Here's your adjusting entry. And then here's your depreciation expense, where you're simply taking that 4,800 and dividing it by 12. All right, let's take a look at some more. So here we've got, again, we've got they paid $4,000 cash to rent an arena. So notice you're debiting prepaid, crediting cash for $4,000. And this is for 2 months. So we know it's $2,000 per month. Just take 4,000 divided by 2. So at the end of October, in this case, you would have rent expense debit, credit prepaid rent for that 2,000. All right, here's going to be a deferral. So notice how you receive cash for season tickets in advance. So you're going to be debiting cash, crediting deferred revenue for that 16,000. And it's going to be for 2 events. So it's literally 8,000 per event. And so after the first event, that 8,000 needs to be recognized as revenue. So you debit deferred revenue and credit your service revenue. Couple more. So notice we've got you paid for some insurance. Here's going to be some prepaid insurance. Debit prepaid, credit cash, and this is for 3 months. We know it's going to be $1,000 per month if you just divide that by 3. So every month it's going to be debiting insurance expense and crediting prepaid for that adjusting entry. All right, here's another one. It says you receive some cash in advance. Debiting cash, crediting deferred revenue for $12,000. And notice it's just uniformly, so you just divide by 12 to get your monthly revenue. That's what they're showing you right here. So every month you'd make an adjustment, debit deferred revenue, credit your service revenue by what you've earned. All right, so on the next one, you've got, this is going to be some supplies. So it looks like they paid cash for supplies. So debiting supplies, crediting cash. Here's your prepaid or deferral. And then you've used $200 at the end of January. So you need to debit your supplies expense and crediting supplies. All right, here's another deferral where you receive some cash up in advance. Debiting cash, crediting deferred revenue. And it's for 3 races, so you just simply say divide it by 3. We know it's $1,000 per race. So after every race, you would be debiting deferred revenue and crediting service revenue. All right, and then here's some prepaid insurance. And notice they paid this. They've got $7,200. It was purchased on July 1st. It's for 24 months. And then they want you to prepare the adjusting entry on December 31st. So assuming you have not made any adjustments, remember your time period from July through December is 6 months. So down here, what they're showing you here is if you take 7,200 divide by 24 and then multiply by 6, that's going to be your monthly insurance, or for 6 months, that's going to be your 6 months insurance. So this adjustment is showing you what should have happened over 6 months. So debiting insurance expense and crediting prepaid insurance. All right, check out a couple more. So in this one, we've got they received some cash from a customer for a 1-year subscription. So notice they're increasing cash, increasing your deferred revenue and your liability. And notice here's your account names, debiting cash, crediting deferred revenue. And then they would, again, post these to your ledger. Here's one where you receive some utility services at a cost of $3,000. So you've actually incurred the expense. It's on account. So you're going to increase your expense and increase your liability. Here's your debit to your utilities expense and credit to accounts payable. All right, here's one where you're actually going to be earning some revenue. So you've got, they provided $2,000 of subscriptions for which they previously had received payment from. So notice you're going to be reducing your liability and increasing your revenue. Here's your adjusting entry, debit deferred revenue, credit your revenue, and then of course post to your ledger. All right, another one. We've got, you have an adjusting entry for depreciation. And again, they're just giving you the amount. So we know it's going to be depreciation expense and accumulated depreciation. Notice that's the contra asset. Here's your adjusting entry. And then that would be the appropriate post to your ledger. I think there's just a couple more. We've got, here's just a prepaid rent payment where you bought some rent in advance. So debiting prepaid, crediting cash. Notice that's just shifting assets. Here's your regular entry. This is not an adjusting entry yet until you've actually used it, but here's establishing your prepaid. All right, last one says you billed the customers because you provided the services, so you've earned it. So that's going to be accounts receivable and revenue. So debit AR, credit revenue, and then you post it. But notice again, here's your asset accounts going up and your equity account revenue is also going up. All right, I think that's it. And then there'll be some more illustrations on some of the textbook problems as well as the homework.